The July 4 holiday week has a dip in the new listings and sales activity and marks the start of the seasonal housing market decline for the second half of the year. Bond markets don't ever rest, and due to recent inflation news, mortgage rates are at the highs for the year. As a result, we can see some of the mortgage indicators from, for example, the MBA and Zactus showing mortgage application slowdown. So when there are fewer buyers, fewer people are applying for mortgages. Even though the weekly pending sales numbers are still ahead of last year, that's a signal probably worth paying attention to. How sensitive will homebuyers be in the summer months if rates stay in the upper sixes? So far this year, we've measured slow, steady growth in housing demand. So let's recap the data. Our pending sales are 3.9% above last year through July 10. Inventory is no longer growing, with fractionally fewer homes on the market now compared to last year. Days on market is now only 4% longer than a year ago, and that's falling. Price reductions are pretty high, but a little less than last year at this time also. So these are small improvements in demand nationally, but they've been pretty consistent all year. The question is whether that trend can hold. So I'm Mike Simonson. I do these videos every week so that you can be tuned in to what's actually happening in the housing market right now. All right, let's look at the picture with all the latest data. I thought I'd start today showing how mortgage rates move over time and how this year's affordability scenario looks in comparison to recent years. So in this chart, I'm showing the distribution of mortgage rates for each of the last 15 years. Each dot is 1 week's average of the mortgage rate. You can see how in most years, the rates cluster around a range with some breakout moments higher and lower. 2022 is the middle here with that big range from 3% at the start of the year to all the way to 7% by October. So I'm sharing this view so you can see how the cost of money in 2026 is still slightly lower than what it's been for most of the past 3 years. 2026 is the bottom row on this chart here. You can also see why it's under 6%, where I'd see more notable sales pickup. Is where I'd expect that. But if the inflation news or war news or oil prices or even a sudden pickup in the jobs data spooks the bond market, we could see 7% mortgage rates again. The recent momentum has been pushing rates higher, not lower. The news has really been falling in the wrong direction. So that fact that mortgage rates are at 6.6% is actually not unexpected. At the beginning of the year, we forecast mortgage rates would average the year at around 6.4, which is roughly the experience we've had so far, a little bit below that and a few months above that. For the first half of the year, as mortgage rates were lower, inventory moved lower too compared to last year at this time. There are now 1.07 million homes on the market, including single-family condos and townhomes. That's down 1.2% for the week. That data includes the 4th of July holiday. So it's not uncommon to have a drop in supply. The count is 0.2% fewer than last year at this time, basically unchanged from last year. So in this chart, each line is a year, and you can see the blue line is roughly the same level as the purple line from last year. There are 15% fewer homes on the market now nationally than in 2017, which I've illustrated here in the gray. There are 30% more homes on the market now than in 2024, which I've illustrated in the orange. So all the inventory growth, though, happened a year ago. And this inventory story has been really the same for a few months now. Growth is gone. Shrinking supply, it isn't shrinking further, and I don't anticipate further shrinking as long as rates stay in the mid or upper sixes. If we get lucky and rates dip closer to 6% again, then I could see supply resuming this downward trend again. But like I said, the pressure is actually in the other direction now. Our forecast models currently expect inventory to end 2026 with about a 3% gain. Pending home sales came in at just over 76,000 for the week. That's the holiday week. That's a dip of 10% for the week. Sales were still 4.4% ahead of last year at this time, week over week compared to last year. After a nice few months of growth in the weekly pending sales, there are now more homes in contract to close than at any time since 2022. This is a chart here is a 4-week rolling average to smooth out some of that weekly noise like the holiday. The blue line is staying above the purple line. Not by a lot, but it shows that sales are still coming in above last year. 84,000 is the recent average of home sales per week versus 81,000 sales per week last year. These are the pending sales, so they're going into contract. And you can see how these pending sales, the blue line is above last year in May and June. And we've been talking about this for a few months now. Last week, NAR's data confirmed in their existing home sales report that they measured June sales above last year also. That shouldn't have been a surprise to anyone paying attention here. Zillow also reported a nice year-over-year gain in their June sales data. So anyway, that's the reason we track this data each week, so you don't have to wait until next month to understand the market now. Since mortgage rates are now at the highs for the year, I'm going to be interested in seeing how the weekly sales numbers react. The big difference between this year and last year is that mortgage rates are about 15% cheaper now, but really, perhaps more importantly, we have a lot more like stock market wealth and business profitability now. And I've talked about this wealth effect driving some home purchases, even as the cost of mortgages detracts from that demand a little bit. So we have this balance between the wealth effect and rising rates. Notably, last year, the economy was still reeling from the massive tariffs. So at that time, we had high rates and much less of a wealth effect driving demand. Demand was hit from both sides a year ago. For our look at home prices today, I thought we'd use the Case-Shiller Index across the country. The Case-Shiller Index is lagging data. This data is really through April, but it's a very high quality view of the changes in home valuations. So in this chart, I'm showing 3.5 years of data per city with the percentage change in home prices compared to the year prior. So in the last 3 years, you can see how almost every city's price growth has slowed. And that's that downsloping line for each city here. The purple cities in this chart are priced below last year at this time. 10 of the 20 cities here in the Case-Shiller measure have prices below below last year. Seattle is currently the worst performing price market with home prices currently 2.2% below last summer. Tampa and Miami, on the other hand, have made a remarkable turnaround. Tampa's home prices are still below last year, still falling, but that slope has changed and is climbing. So Tampa is now 1.8% less than a year ago. It was 4.5% earlier. So that slope has changed. And Miami actually has home price growth compared to last year in the Case-Shiller data. San Francisco also has home prices climbing for the first time in a while. San Francisco and Miami may be both seeing demand rise due to that wealth effect that I mentioned. Chicago continues to lead home prices higher. This is not because there's some giant wealth effect driving demand in Chicago. It's really because supply is so tight. In Chicago, there are 75% fewer homes on the market now than in 2019. 75% fewer. The blue cities in this chart all have prices above last year, climbing. You can see Chicago, New York, Boston, Detroit, but also now Miami and San Francisco are in the blue cities. But even in Chicago, the changes are uneven. So city condos downtown continue to be under pressure, while it's the suburban single-family homes that have a dramatic shortage and buyer competition. Nationally, home prices are up versus 2025, but only by 0.8%. That's the lower right-hand corner, the orange there is the national chart. Given the little rebound in Florida and California prices, the national average is actually up a bit for March. So 3 takeaways on home prices right now. Tight markets like Chicago and the New York tri-state area continue to have home price appreciation. Since inventory is so much tighter in Florida now than it was a year ago, much of the price drops in Florida may be behind us. And since inventory is no longer growing across the country, there seems to be stability in prices going forward. So all these signals are, of course, really the result of that spring buying season, which we just concluded. I'd call it the best spring since 2022. In the back half of the year, the market faces risks from inflation, from maybe more energy shocks with the war, and stock markets that could take back some of the big wealth effect that's been driving home buying demand in some of these major coastal cities. 2026 has finally had some gains, but they may be fragile. So stay tuned for more. Thanks, everybody.